Hello traders and welcome back to another episode of Smart Risk. Are you looking for a reliable method to execute trades in the market? We'll be delving into this powerful strategy that offers safer entries and increased confidence in your trades. We'll dive into the specifics of this strategy, explaining why it's a game changer for traders seeking safer entries and consistent results. Moreover, we will explore the candlestick patterns, the psychology behind this trading strategy, and the price actions associated with it that you might encounter in the market from basic to advanced. But that's not all. We'll break down the key criteria and rules you need to execute winning trades with this entry method. So traders, if that's something you're interested in, please give this video a thumbs up to show your support, and subscribe to our channel if you are new. See you after intro. Welcome back, traders. So, let's get started. Using the candle breakout strategy for placing entries offers one of the most reliable methods for executing trades in the market. While it may have a slightly lower reward-to-risk ratio, this strategy provides safer entries compared to other methods. Before delving into the specific steps and instructions of this strategy, it's essential to understand the rationale behind it and why it's advantageous. To increase the number of confirmed trades in the smart money concept, we follow several guidelines. For example, we consistently wait for prices to reach key zones, such as the supply or demand zones on higher time frames. Next, we zoom into lower time frames and look for signs of a shift in market structure, such as a change of character pattern. For example, we wait for the price to break and close above this structure. Subsequently, we consider executing a trade on the pullback. As you know, guys, most of the time, the price doesn't make a deep retracement to activate the extreme order block generated by the change of character on the lower time frame. In such scenarios, what alternatives should we consider to prevent missing market entries? We have two potential options to explore to ensure we don't miss out on high-probability trades. Firstly, after identifying the market structure shift on the lower time frame, we position our buy or sell limit order at the imbalance or fair value gap created by the change of characters wave. Then, we wait for the price to trigger our pending order and initiate our entry into the market. We've thoroughly covered this entry technique in our previous episodes. However, what if the price simply starts to accelerate without retracing? In such cases, we require an entry method and trading strategy that consistently engages us in the market. To address this, we turn to the second possible method for executing trades. Here, we focus on higher time frames and implement the candle breakout entry method in our trading strategy. Let's break down the basics of the candle breakout strategy. Detecting breakout. The first step involves identifying a breakout of a key level structure on the chart. This breakout is typically signaled by an engulfing candle, where price breaks through a key area with strong momentum. Engulfing candle breakout. The breakout occurs when an engulfing candle forms, indicating a strong shift in momentum. This candle pattern engulfs the previous candles, signaling a significant move in the market. Applicability across time frames. While this strategy can be applied across various time frames, it is most effective in higher time frames. The clarity and reliability of the signals tend to be higher in longer time frames. The candle breakout strategy comes with its advantages. You're less likely to miss entries, and you don't have to constantly monitor the charts. It is more consistent as you know where are you looking for exactly and what criteria you need to consider. However, there are drawbacks to consider. You might sometimes experience fakeouts. Since this entry method involves a larger stop-loss area, it provides a lower reward-to-risk ratio. Let's outline the main criteria and rules for executing an entry in this trading strategy. Entry should occur on the breakout of a key level identified on the higher time frame supply or demand area. Entry points are only considered valid on specific time frames: 30 minutes, 1 hour, 2 hour, and 4 hour. These time frames are the only ones applicable to this strategy. Now let's dive into the various instructions of this strategy and see how we should use them to execute trades in the market. Let's imagine that we have a bearish structure on the higher time frame like 1 hour. We see that price has created a great liquidity pool above the equal highs, which is located just below the most recent unmitigated bearish order block. The main idea here is to wait for the price to reach key areas such as unmitigated supply or demand. This approach provides a relatively safe opportunity to enter the market. So we have this most recent unmitigated supply zone over here. As price's general direction is bearish, we are looking to get into the market by opening sell positions. Now let's consider a scenario where we have a pullback to the supply zone, and the price has entered the most recent unmitigated supply zone. We are now waiting to enter this zone. The candlestick pattern we want to see near the supply zone is like this. Firstly, we want to see an initial candle that pushes into the point of interest. Subsequently, the price starts to react to the zone and shows rejection from it. This reaction can occur with a single candle or multiple candles. And then we need to see an engulfing candle that breaks out of the supply zone and also engulfs the reaction candles. This doesn't always occur within a 3-candle sequence like this. It can happen within more candles as well. Essentially, what we're looking for is the last candle to engulf the reaction candles and break out of the supply zone. This means we're waiting for the price to break below the bodies and also the wicks of the reaction candles. Before moving to trade examples, let's go through some key points that we need to consider to apply this trading strategy properly. As mentioned before, this strategy is applicable across all time frames. However, it tends to work best on higher time frames such as the 1-hour, 2-hour, and 4-hour charts. This is because on higher time frames, most of the mitigation, rejection, and breakout phases occur within the 3 major candles. Therefore, applying this strategy on higher time frames provides better clarity and effectiveness. However, using lower time frames may result in a different scenario. When price reaches the point of interest area on lower time frames, it often enters a consolidation phase with multiple candles as the market determines its next move. This can lead to multiple engulfing candles being formed without a clear rejection phase, and there's a possibility that price may push deeper after creating engulfing candles. Therefore, we prefer sticking to higher time frames like the 1-hour, 2-hour, and 4-hour charts because they provide more reliable signals and clearer confirmation. As mentioned earlier, it's crucial to note that this pattern doesn't always occur in a 3-candle sequence. The main focus is on identifying an engulfing candle that breaks out of the point of interest zone and aggressively engulfs the previous reaction candle's body and wick. Another crucial point to consider is that you should look for this pattern to form when the price hits the unmitigated point of interest, not at random places on the chart or key levels that have been mitigated before. It's really important to stick to all the key points and rules of this trading strategy. If you don't, you could end up losing some of your capital. Now, let's check out some examples to see how it works in real trades. But before moving to the next part, it's important to note a crucial step in your trading journey: backtesting your strategies. Before applying any strategy to your real account, it's recommended that you backtest it at least 100 times. To help you with this critical step, we use the TraderEdge platform for backtesting our exclusive trading strategies. If you're interested in using TraderEdge as your backtesting tool, be sure to check out the link in the description below. Here we have Euro-Dollar 1-hour time frame chart on the screen. We are looking to go short of it. The market is clearly in a downtrend, having established a series of lower lows and lower highs, indicative of bearish sentiment. Recently, price made a bullish move, sweeping the liquidity pool formed by equal highs, and now it's approaching an unmitigated order block, created due to a significant inefficiency in the market. One potential entry method is to place a sell limit order at the lowest point of interest, waiting for the price to reach this level and trigger the order. However, for a more confirmatory and safer entry, we can employ the candle breakout strategy. This involves waiting for a specific candlestick pattern to form, signaling a potential reversal or continuation of the downtrend before entering the market. To execute the candle breakout strategy, we first need to wait for the price to reach the key area of interest. In this case, we see the price pushing higher into the extreme 1-hour point of interest with several bullish candles. However, as the bullish momentum subsides, it suggests that the mitigation phase is drawing to a close and the rejection phase is likely to commence. The initiation of the rejection phase becomes apparent with the emergence of a bearish candle, following a series of successive bullish candles. This indicates a potential shift in market sentiment from bullish to bearish, signaling a possible reversal or continuation of the downtrend. We've identified the first selling candle within the area, which serves as the reaction candle. Following this, we notice that price forms an engulfing candle, breaking below the area while engulfing its previous reaction candle and some of the mitigation candles. This confirms that price is also respecting the point of interest. With this confirmation, We're now authorized to enter the market by initiating a short position from this point. To initiate this trade, we wait for the closure of the engulfing candle to set our entry at the same level. Our stop loss is placed above the highest point of the recent candles to manage risk. For the take profit, we have a couple of options. We can aim for the most recent bullish fair value gap, or we can target the upcoming major sell-side liquidity. However, it's advisable not to set the take profit too far, as we prefer not to keep our positions open for an extended period. Let's examine another trading example on the Euro-USD 1-hour chart. In this scenario, the price is currently in an uptrend and has been forming bullish breaks of structures to the upside. There's an unmitigated order block at the extreme, along with dynamic liquidity forming below the bullish trend line, suggesting a potential opportunity for a long position. We're expecting the price to push lower to mitigate the extreme order block, and if we receive the confirmations we're seeking, we'll consider entering a long position. Let's see how the price action unfolds. As anticipated, the price pushed lower, sweeping through the liquidity accumulated below the trend line and reached the unmitigated key area. Examining the candlestick formation at this point, we see a 3-candle sequence. Initially, the first candle mitigated the key area, followed by the price reacting to the zone and showing rejection from it with the second candle. Now we have the confirmation we were seeking in this trading strategy, an engulfing candle breaking above the order block and engulfing the previous reaction candle. With this confirmation, we're ready to enter the market by going long. To do so, we'll place a buy order at the closure of the engulfing candle and set our stop loss below the lowest point of the reaction candle. For the take profit, I'm targeting the buy-side liquidity above this swing high. Let's see how the price action plays out. The price action played out as expected. After the formation of the engulfing candle, price pushed upwards with significant momentum, eventually reaching above the swing high, and our take profit level was successfully hit. Now, let's examine another trading example. We're looking at the EUR-USD 1-hour chart. Currently, the price is in a downtrend, having formed bearish breaks of structures to the downside. At the extreme end, we have an unmitigated order block, resulting from a significant inefficiency in the market. Additionally, there's a substantial liquidity pool above these highs, awaiting clearance by the price. These factors highlight the extreme order block as a crucial zone for potential short positions if the price retraces back up and mitigates the order block. Let's see how the price action unfolds. Currently, the price has pushed higher with considerable momentum, effectively inducing this order block and sustaining its bullish trajectory. Despite tapping into the extreme order block and partially mitigating it with multiple candles, there hasn't been a breakout accompanied by an engulfing candle. So let's see how it unfolds. Eventually, the price forms an engulfing candle, breaking below the order block while engulfing previous reaction candles. Consequently, I'm going to enter a sell order at the close of the engulfing candle and set my stop loss above it. As for the take profit, I'll target the nearest swing low as the first target, and the subsequent lower swing low as the second target. Now, let's see the outcome. The price keeps descending, and we've just reached our first take profit target. Now we've hit the second take profit target as well. Great to see both take-profit targets being reached. It seems like the trade played out as anticipated. That's it, traders. Thank you for watching this video. I hope you found it informative and useful.